For years, sellers held all the cards. Now that housing shift is putting the ball in the buyer's hands, especially here in the Sunshine State. Welcome to Dre's Take. Nationwide, sellers are sitting on market longer, cutting prices, and buyers are walking away from sky-high asking prices. But let's zoom in on Florida and let the numbers tell the story. We tend to measure whether it's a buyer or a seller's market based on how many months it would take to sell through the existing inventory. It's pretty simple. Anything north of 6 months is considered a buyer's market. Anything south of 6 months is considered a seller's market historically. Right now in Florida, that number is about 6.5 months worth of inventory, clearly denoting what we would consider a buyer's market. The reasons for such inventory are a combination of new construction inventory finally hitting the market, saturating the market, and existing listings just sitting on market far longer than expected. And it's sort of a which came first, the chicken or the egg scenario. The homes are sitting longer because less buyers are active in the marketplace, which is causing more inventory, which is causing the month's worth of inventory number to swell. So the real question comes down to, why are buyers saying no? And the answer is quite simple. It's affordability. It's not that people don't want to own homes. It's that the asking prices being where they are, coupled with elevated mortgage rates, just makes it so they can't. So even though there's more inventory available, more options to choose from, and better negotiating power, that still doesn't translate into housing feeling more affordable for people who would like to buy. As it stands right now, I would consider this more of a balanced market. I think we all kind of got used to the post-COVID market where homes were flying off the shelves and values were running up through the roof, and it was just a crazy time. But right now we're back to pre-pandemic levels, but still a far cry from the post-recession recovery era. So this is more of a balanced atmosphere. It may seem a little tighter than it has in years past because of the crazy market we just came out of, but in all reality, it's more of a balanced market for the time being. If things stay this way for even longer, meaning that if housing costs don't really improve and buyers continue to stay out of the market, then things could turn into a more desperate situation, shall I say, where sellers race to the bottom to try to meet the market where they want to be met. But we'll have to wait and see if that happens. As of today, the Fed just cut the Fed funds rate 0.25%. And the talk seems like they're anticipating more rate cuts in the future. That doesn't always relate to lower mortgage rates, especially not right away, but it is a sign of good things to come as borrowing costs go down across the board. Over time, you'd expect to see a correlation with mortgage rates following at some point. Maybe not right away, but at some point. As it stands today, it's still kind of a toss-up. We did watch mortgage rates tumble since my video 2 weeks ago where I said they wouldn't move very much. They fell about another 20 basis points or so, which is, don't get me wrong, significant and maybe a little more than I had anticipated, but it's also not a bottoming out of mortgage rates by any means. And we have seen last year when the Fed last cut their interest rates, the first interest rate cut since last December. And when we seen them cut for the first time in that September, I want to say it was, we actually watched mortgage rates go up. So there was an inverse relationship during that cut where mortgage rates actually went up. And we're hoping we don't see a repeat of that. And if there's any metric that's going to keep that from happening, I'd say it's probably the jobs numbers, which are not looking very good. The most recent revision pushed, I believe it was July's numbers down into negative territory again. We keep getting these revisions. Whereas in months past, they say, we had 100 and some thousand jobs created. And then when we revise the numbers and look at the actual data, we're actually negative in job creation. As long as that continues, I think that's the main figure that the investor market is looking at that's having an impact on the bond market that's continuing to drive mortgage rates down. So it's kind of like is it good, is it bad? You know, I mean, on one hand, mortgage rates are coming down because of the jobs reports. On the other hand, it means that people are losing jobs and that there's less jobs out there available for folks. So catch 22 there, pick your poison. Anyway, for the time being, things aren't changing a whole bunch. Median price point still hovering around 400,000, and the interest rates are still in the low to mid sixes based on your credit, which hasn't really improved affordability a whole heck of a lot. We'll have to kind of wait and see where it goes from here. The next month or two will kind of tell a little bit of the tape, and then spring will really tell us where we're at as far as the housing market goes. I got to run because I got a final walkthrough I got to get to today, but I did want to drop in, leave you with a little bit of Dre's take. And so that is going to be Dre's take for this week. If I can help with anything, buying, selling, investing, with your real estate needs, just feel free to reach out. I'm always happy to help. And until next week, that's Dre's take. All right, y'all. Peace.